Hi, I'm going to take you through a brief on motor insurance. So motor insurance is one of the most common types of insurance within the Kenyan market. Unfortunately, it's also one of the most misunderstood types of covers which we have. So the first thing which I think is important is grasping a clear understanding of what motor insurance is. For motor insurance, this is basically a type of insurance which is purchased and offers protection against road-related risks to the motor owner, whereby the motor can be a motor vehicle or a motorcycle, which is also something you should note that it's a legal requirement for your vehicle or motorcycle to have insurance prior to it being used on the Kenyan roads. So what basically is this insurance now? Because one of the main things which you should be able to note is the types of insurance, whereby there are very different covers which look the same but cover different aspects. So for you to have the motor insurance, you are generally issued with a certificate which you are supposed to display, whether it be on a motorcycle or your motor vehicle. So for the motor vehicle, this is generally attached on the windscreen, whereby it can easily be viewed and the details should be clear at all times. For the motorcycle, they can also attach it to their motorcycles or attach it to their keys, such that in the event of anything, your motor insurance details should be immediately accessible. The types of the motor insurance: first, there is the third-party only insurance. Next, we have third-party fire and theft insurance. And finally, we have the comprehensive motor insurance. For the third-party only insurance, this covers against liabilities to third parties. This is usually a very confusing term to most beginners within the insurance field. When they say third-party liabilities, these are the losses caused by the insured vehicle to other people's property or lives. So in the event that your vehicle, which has this third-party only insurance, hits someone and this person takes you to court, your insurance can step in and help you cover some of these liabilities. This is also good to note that this is the least type of insurance which you can purchase. It's the third-party only insurance, and as a matter of fact, it's also the cheapest which you can be able to procure within the market. Next, we have the third-party fire and theft. For the third-party fire and theft, now you have additional covers over and above the third-party insurance. Now you're also covered against losses to your vehicle caused by fire and or theft, whereby let's say your vehicle burns. Now you can be able to be compensated for such a loss. Let's say your vehicle is stolen. Now you're able to be compensated for such a loss. Finally, we have the comprehensive insurance. For this comprehensive insurance, it covers what we talked about for the third-party only insurance. It also covers the losses related to the third-party fire and theft. And in addition to this, it also covers losses related to accidents. So in the event of an accident, whether you are to blame or the other party is to blame, subject to the limits within your insurance, you'll be able to be compensated for the repair cost. And also in the event that your vehicle is totally damaged, you'll be able to be compensated as a write-off, whereby you'll be issued a specified sum amount which will be able to compensate you and help you maybe go buy another vehicle and leave the salvage with the insurance company. And by salvage, I mean the wreck or what is left of your vehicle after a major accident is referred to as a salvage. And for the motor insurance, these types of covers which you've mentioned, the three of these, they run across board, irrespective of the type of vehicle. But for the type of vehicle, there's also a specified insurance for this. And this is usually distinguished by color and by the writings on the certificate which you are able to display. So first, generally, most of the vehicles on Kenyan roads are private vehicles. For a private vehicle, you have to purchase a private vehicle insurance. So this vehicle works the same irrespective if it's the third party or the third party fine theft or the comprehensive. Nature of use of this vehicle is limited to private use or your private business. So this is not a vehicle generally used to carry goods for hire. It's not a vehicle used to carry passengers. And this causes a lot of misunderstandings within the industry. So you find that you had a private vehicle insurance. There's usually a green certificate, by the way, in color. And you, in the event of maybe an accident, you're found carrying passengers, fare paying passengers. So the insurance company can't compensate such a claim because the nature of use of your vehicle was supposed to be private. And then next we have the commercial vehicles. So these commercial vehicles, they start from the pickups and all the way to the trucks, the trailers. So these are vehicles used for commercial transportation or carriage of goods or services. For the commercial type of insurance, this is usually a blue certificate, which you can find now attached to the commercial vehicles. Also, some private vehicles, such as the Probox or the Noah, which are used to ferry goods, sometimes they're forced to purchase this type of insurance because now it's just generally now for the cargo being transported by this vehicle. And also another misunderstanding which usually happens, you assume that since you have the commercial vehicle insurance, your goods are also covered. This is to clearly note that your goods are not insured in such a scenario. It's just the vehicle. The reason why it's different, the risk is different from the private. So generally the risk is higher for commercial than for the private. So you'll find that for the commercial you pay slightly higher than the private under most circumstances. But if you need insurance for the goods, you have to purchase an additional type of insurance, which is not a motor insurance, which is referred to as goods in transit insurance. So it covers now the goods which you're transporting, but the basic commercial insurance just covers the vehicle. Then we have the PSVs. For these PSVs, they are different within the industry. So you can notice we have the digital taxis, the Uber, the Bolt, and such, which are coordinated using apps. So these types of covers are sold separately, and they are mainly referred to as PSV, chauffeur-driven taxi insurance. Then we have the PSV taxi insurance. So this is mainly for the yellow taxis, the general taxis which operate on the roads, and they usually charge higher than the chauffeur-driven because it's also assumed the risk is quite higher on this. And then finally you have the matatu, PSV matatu. This is rarely offered within the industry, just specified, countable. In fact, service providers currently offer this. So this is for the generally the 14-seaters, 32, the public vehicles carrying quite a number of passengers at a go and ferrying a couple of trips within the day. Then we have the motorcycle insurance, of course. Motorcycle is also twofold. You have the motorcycle private, which can be for company use or personal use. And then you have the motorcycle boda. So this is for the motorcycle which is ferrying, fare-paying passengers. And you can wonder what's the difference between the commercial and the PSV. For the PSVs, you pay an additional insurance which is referred to as the passenger legal liability, such that in the event that your vehicle is involved in an accident and you as the owner of the vehicle or the motorcycle, you owe it to your passengers, their security. So in the event this goes to court, your insurance will step in and be able to pay some of these people's liabilities. And also another important thing to note in motor insurance, you should have noticed in all the classes which we refer to, none of them insures the driver. So as a driver, you're not covered by your motor insurance. This is something important to note. If you need insurance as a driver, you have to purchase your own type of insurance, which they're different within the market. You can either get yourself a medical cover or get yourself a personal accident insurance cover, which compensates you for the cost related to an accident, such as medical bills, you being unable to go to work, either it's disability or even death. This compensates you, the personal accident insurance, which is totally different from the motor insurance. And then also another important thing to know is, how do you get your insurance cover? Of course, you can purchase your insurance cover directly through any insurance company which offers motor insurance. You can also purchase your cover through an intermediary, a licensed intermediary that is, whereby within the market we have licensed insurance brokers or insurance agents who are licensed to sell this insurance or help you get this insurance from the licensed insurance companies within the market. The main advantages is across board. You can either choose to buy directly, but the cost is the same. Whether you're buying directly or through your agent or broker, the cost should be the same. And it's common practice for you either way to pay directly to the insurance company. Even if you have your intermediary, it's advisable to pay directly to the insurance company at all times, because for your insurance to start, the insurance company has to confirm payment for your particular cover. So let's say you've paid through an intermediary, the intermediary hasn't submitted this money for one reason or another to the insurance company. The insurance company is entitled to decline such a claim in such an event, whereby they can say they didn't receive the cash which was required for them to offer you this type of insurance. So at all times, it's advisable, whether you're buying directly or buying through an insurance agency or brokerage, just pay directly to the insurance company's official account. The main advantage of maybe going through an agency or a broker can be the advantage of having a variety of options. So in the event that you're buying maybe directly through an insurance company, there's limited reasons or incentives for them to offer you better coverage or a different package from a different insurance company, because that's generally a competitor. But for an agency or brokerage, they're mainly paid through commissions. So for them, they can be able to source for you from the different service providers and help you maybe make a more informed decisions about your type of insurance. Then you have, how do you choose the right insurance? So first of all, start with the personal research. At all times, just do your personal research. Even before asking, general, just look online. There's a lot of information out there. You can be able to get this information through the government website, such as IRA, through the company reports. Just compare, look into what the company is offering, their nature of business, their performance over time, their claims payment, what's the market saying generally about this particular company. It's easier for you to have that personal feel. Even before now you get the actual information from an experienced person, you have your preliminary information which you've gained through your personal initiative. This will help you maybe avoid stereotypes and avoid biases, because within the market there's always a bias. If you come to a person, the person might have his own bias towards a particular company, which is not based on facts but on their own opinions. Next, also interrogate. Just because you're told something is good, just don't take it at the face value. Do your own personal interrogation on this. And also now look at the cost-benefit analysis. Look at what this company is charging vis-a-vis what it's offering. So for you to be able to match and get a good deal generally within the market, there's no point of you paying higher for little service or for you paying less for really poor service. So you should be able to do this matching at all times. Then the process, because a lot of people explain about insurance, the types, the classes, and forget to emphasize on the process. What's required? So the first thing before getting your insurance, you have to fill in a proposal form. So this proposal form is whereby you put in your details. It's more or less a contract now. You're entering into a contract between you and the insurance company. So this form, a lot of people are shy on filling it, and it's usually left to the intermediaries to fill this for their clients. But it's advisable to always fill in your proposal form. We'll also be running a training on how to fill in a proposal form. It's really simple, and it's something you can do in less than 5 minutes actually. Next, after you fill in this proposal form, there's what is referred to as KYC, know your customer. The insurance company has an obligation to collect details to verify that truly they have this particular customer. And for them to collect such information, they'll need, number one, a copy of your identification document. So if you're a company, they'll ask for your incorporation certificate. If you're an individual, a copy of your ID. They'll also ask for a copy of your KRA PIN, which will be needed to be inserted in their system. And then they'll also ask for a copy of your logbook. The copy of the logbook is mainly to verify the information which you've written on the policy document, and also in the event of future reference or dispute or a claim, they're able to verify truly indeed this was the particular vehicle which we offered insurance to. Then after you've gotten your insurance, the next thing you have to pay, of course, before they issue you the certificate. Currently in the Kenyan market, the insurance certificate is digital. The previous certificates which were manual are no longer around. So once you apply for this cover, you're supposed to get an email with a certificate which you're then supposed to print and cut and then stick now on your windscreen or publicly display it. If it's a motorcycle, you can attach it to your keys or something of the sort, but mainly just make it accessible for viewing. Once you made the payment, they issue the cover. If it's comprehensive insurance, they might need to do a valuation of your vehicle. So the valuation is mainly for them to verify the value of your car, also for the third party fire and theft. Because in these types of covers, in the event of losses related to fire, theft or accident, in the case of comprehensive insurance, the insurance company has to know prior. So let's say this person's vehicle is completely destroyed or it's stolen. How much are we supposed to compensate this person? So without a prior valuation report, this can be a bone of contention because it opens a gray area where you could have overinsured your vehicle or underinsured it. So for underinsurance, this is whereby you paid less than what was needed for the value of your vehicle, and for overinsurance you paid way above what you were supposed to pay, maybe for the type of insurance which you have. It's also good to note for the payment of insurance for your third party fire and theft or comprehensive insurance is usually as a percentage of the value of your car. So you can be assuming maybe you bought your vehicle 3 years ago. You're still using that as the value today, which is wrong. So you're supposed to get a competent valuer, which is usually in the panel of the insurance company. So they can give you a list or just choose a valuer for you. And this valuer will be able to do the valuation, and it's supposed to be included in your premium. So it's not something you're supposed to pay again, unlike the normal valuation which you do maybe in hire purchase. Once you have now your cover, for this process to be able to make sense, when applying on your proposal form, you give them an estimate. You can see maybe my vehicle is valued at 800,000. So the insurance company, common practice, if it's your first time with them, they'll tell you, okay, we'll give you a cover for 1 month. Within this 1 month, we'll need you to do the valuation. After the valuation is done, you'll be able to know the exact value of your car. You can be saying it's 800, the value can say it's 750 or 900. It depends on the valuation. So now you'll pay the balance of your premium based on the valuation report. And by premium refers to the amount which you pay to the insurance company for you to get this particular type of insurance. Then finally, the most stressful part of motor insurance in the market, and that's the claims. For claims, the first thing which we need to know is claims is controlled and governed by the terms within the policy document. So after you purchase the insurance, you're also supposed to be issued with a policy document. This policy document explains mainly the A to Z of your insurance cover. What are the limits, what is covered, what is not covered, how you're supposed to go about your claim. So the general practice, once a loss occurs, the first thing to do at all times is report. So you report first to the police station, nearest police station, traffic police station, and also report to the insurance company. When reporting to the insurance company, you have to fill in a claim form and attach copies of the driver's license who was driving at that time and a copy of his ID. This is to verify who was driving the vehicle. And the claim form describes everything which occurred during the accident, and you'll also be needed to attach a copy of the police abstract. And it's also good practice if you have a camera at the moment of the claim or at the scene of the accident, just take photos and also attach them. They usually help with fast tracking the process and verifying this particular information. And then also another thing to understand in motor insurance are some of the common terms. So you can hear terms such as sum insured. So sum insured, this is mainly the value of your vehicle or what is covered, up to what limit. If the value of your vehicle is 1 million, that means you're covered up to 1 million for the value of your vehicle. So in the event of theft of your vehicle, there's no way the insurance company can pay you anything over and above the 1 million. Then we have valuation, which I mentioned earlier. So valuation is whereby it's a process whereby the insurance contract services of a competent and licensed valuer to issue a value of your vehicle, which is usually the current value of your vehicle. And this is it's a market value based on the set procedures and market dynamics within the particular moment. Another thing to know is something referred to as assessment. In the event of an accident, an assessment is supposed to be done. Now this is both ways. So in the event that you're claiming against a third party for losses caused to you by a third party, or if you have the comprehensive insurance and your vehicle has been involved in an accident, so the first thing which is done even before they say which particular amount you're going to be paid or the cost of repair, they need an assessment report. So assessment is whereby the competent assessor looks at the vehicle and estimates the damage and the cost of repair. The assessor is also supposed to do another assessment, which is reinspection, to ensure that the things which were highlighted in the assessment report are actually either replaced or repaired. Then you can also have investigation. Investigation occurs whereby you've had a claim, but it seems suspicious, and the insurance company wants to confirm some of this particular information. So they usually contract investigators who look into your claim, and they are able to verify the particular things which you wrote in the claim form are actually the things which occurred. So the investigator will then submit his or her report to the insurance company, either verifying or denying what you wrote. So these can be contentious. Sometimes what they write is really not what happened, but it's based on their professional investigation and what they've been able to find out. So you can always appeal if you find maybe what they've written is different from what you experienced, that is. Then, very tricky subject in motor insurance is what is referred to as excess. Excess, this is the amount which is borne or paid by the insured when compensation of a loss is taking place. So in the event of maybe an accident or theft, the insurance company won't pay the whole cost of insurance. There's an amount referred to as excess, which is usually supposed to be paid by the insured. So this is to limit the bad use or the abuse of insurance. So you're supposed to know that in the event of a loss, I'll also suffer myself, because there's an amount which I'll pay. The insurance company will pay everything. So that's usually referred to as excess. So it's common practice. You can also insure against paying this excess in some cases. They have something referred to as excess protector, which it's just the discretion of the insurance company. They can give you an option to pay, while paying the premium for your insurance, also insure against paying some of these excess amounts. So this is usually capped. They can tell you something like the excess for this vehicle is 2.5% or a minimum of 30,000. So if your vehicle is valued at 1 million, do 2.5% of 1 million, you get 25,000, but their minimum was 30,000. So that means in the event of a loss related to an accident, you're supposed to contribute 30,000 towards the repair. And this excess differs depending on the risk and the loss. So in the event of fire, the excess can be different. It can be maybe 10% or even 20%. In the event of theft, it's generally 20%. But if you've taken some mitigation measures, such as incorporating a GPS car tracker or an alarm system with a cutoff, you can be able to get substantive reduction on your excess, maybe to 10 or even 5%. But this excess is usually a very tricky subject, because the general assumption is once I've bought insurance, I'm totally covered. Especially once I've bought comprehensive insurance, I'm supposed to be comprehensively covered. But in practice, it's good to always note what are the excess and what are these limits. And this information, you can easily find it on the policy document, or also inquire it even before purchasing this type of insurance. Then finally, we have something referred to as contribution. Contribution is commonly confused with excess. This is totally different. Contribution is subject to certain terms and conditions in the policy document, whereby if the loss is related to some parts, you have to also contribute. Let's say it's something related to wear and tear. It's a part which was previously damaged and you repaired it, and now after insurance, it has a loss at the same time. So the insurance company can say, there's no way we'll purchase a new one, yet yours wasn't new. It had some dents and previous damages. Also some things some parts, such as batteries, tires, there's usually a contribution aspect. It can be 50-50, 70-30. So these are ratios. So if it's 50-50, the insurance company will say, okay, the cost of purchasing a new tire is 10,000. But since your tire was worn out, and as a principle of insurance, you're supposed to return it to your original position. So for us to mitigate this, you'll contribute 50%, we'll contribute 50%. So you pay 5,000, we pay 5,000. So this is also stipulated in the policy document. So we found that a lot of people, once such things occur, they mainly feel as if the insurance is stealing from them. But it's common practice within the industry. It's across board, and it's advisable for you to always look at your policy document and easily understand these things before purchasing your insurance cover. Finally, in the event of questions, you can always reach us through our email, info@onsure.co.ke, where the spelling of onshore is ONSURE. You can also visit our website for more information, and also to get your insurance through us, you can contact